Alrighty, now we're going to be doing the income statement. Now remember, the income statement is the information that we're getting from the worksheet. Remember the gross sales, okay? Getting it from the worksheet here, we're looking at the sales for the 96,000 right here, 96,000. So you're seeing here again the $96,250. Now, what we're going to do though, this is the income statement, but it's more of a excuse me, classified income statement because we're actually going ahead and we're doing more with it. This is a sales company, remember, a merchandise company. So we're now going ahead and this is the gross sales. This is the returns and allowances, that things that were sent back, given back to us. They didn't like it, didn't fit, whatever the case may be. That's how much we brought back. Then this is how much of the inventory that we had based off the sales, the money that we're not getting, that we're not bringing in, because we gave a sales discount, we didn't sell it at full price. So when you add these two together, you end up with $5,830, bringing down your gross sales to now $90,420. Okay, now we go to the so our net sales is this amount. Now we go to the cost of the goods sold. We're now saying how much did what I sold this past month? How much did it cost me? Okay, so what we're doing is we're actually looking at the cost of the merchandise inventory, which is the beginning of the 11,200, because that's what we began with when we started the month of November. Okay, so we made these purchases. We had so much that we had to return. So obviously, if we're returning them, that in a sense is still a cost because it's not something that you can sell when you return it. Then you also got some discounts. So we're now looking at the amount of money that we actually purchased less the $16,770. So now we're looking at, okay, only having the $47,030 of the net purchases, okay? So we're bringing that down, showing exactly how much we actually purchased. Then we have to bring in the freight because, again, remember that is also a cost. So we add the freight, bringing the net cost of the purchases to $49,730. Okay? Now, the cost of goods, so the cost of good that are ready for sale, okay, that we're looking at is going to be, so is, excuse me, I had to pause because I was coughing. So anyway, what we're looking at then is the net cost of the purchases, again, is this amount. Now, the cost of the goods sold or that were available for sale is this amount. Because again, this is the merchandise. This is how much it cost us. So this is the cost of goods that are available for sale, which means this $11,000 of merchandise cost us this amount. So we add it, all right? Giving us the $60,930. Now, less the merchandise that we still have, well, you're going to see that then your cost of goods sold is only $50,330, right? So when you subtract the cost of goods sold from your net sales, then your gross profit is only $40,000, $40,090, okay? Because we're taking away the costs that everything was there. Now, this is the gross profit because remember, to determine how much you really made, then what you're doing is you're taking away all the expenses, your advertising, your rent, a lot of rent expense here, salaries expense, okay, your depreciation, your insurance expense. So total operating expenses. Now, those are total operating expenses to operate the company. Comes to $35,510. It's a lot. So your net income from operations is only 45 or 44,580. But then you have to show the training income that you earned that month, even though it was still in unearned, you still have a balance there. You have to show that you still earned that this time. So bringing your net income to 49,000, I mean 49, $4,930. Okay. Now that should show you the same amount here on your income statement, $4,930. All we're doing is plugging the same numbers in, so you should still balance. Now remember, the statement of owner's equity, all it is the capital that he put in, the net income that we're adding in, okay, but minus the withdrawals. So he withdrew $4,300. So his increase in capital is only $620. So when you add that together, then his capital then is now $11,120. Now remember, the increase in capital is only this amount because he took money out of the company already. That's why. Okay? That's why you have that amount for the owner's equity. Now on the balance sheet, remember, you're taking your assets, your prepaid insurance is on this other side. Okay? Your assets are going to be this amount. I'm sorry. Your assets, your total is this amount. This is neither debit or credit. It's just showing you all your assets are equaling now to $17,170. Your equipment and your less the depreciation, okay? When you add these two together, you have $2,090. So now you're actually not adding it. When you subtract, I'm sorry, let me go back. When you decrease your plant equipment only on this sheet for the amount of depreciation, then your equipment is only $2,090. So when you add that to the total current assets, then you get a total asset of $19,260. Now we come to the current liabilities. So you add here. That's why it told you that your mortgage payment was here. It was a mortgage payable. Okay? So we added here of $980, your accounts payable, your unearned training fees, because again, and the reason that it's considered a liability is because you haven't earned that money yet. You still have to earn it. What if they decide, okay, you've already trained me enough, I don't want any more training? Then you have to return that amount. So you're liable for the training still because you haven't done it. You can't show it as an actual asset because it hasn't happened and because they could decide to cancel the contract. Okay? So your current liabilities then are $7,770 that are here. You bring in your mortgage, your long-term mortgage payable as well. So now you have a total of $8,140. When you add the $8,000 to the owner's equity that you get from the owner's equity statement, you add that together, then guess what? You balance out to the $19,260, which is, again, the same amount as your assets. Because remember, the formula that we have, assets equal liabilities plus owner's equity. So here's your assets equal liability plus owner's equity. They balance out. All right. Now the journal, very simple. These are the adjusting entries. The income summary, this is how you put it in and you journalize it. Your unearned training fees, your depreciation, your insurance expense. Now you're doing your closing entries. Remember your closing entries, which is your sales, your training fees earned, your returns and allowances, your discount. So this is your income summary here, and you can check it back with the worksheet. Okay, your income summary, then your returns and allowances, everything that is actually shown as well, and then your income summary and your withdrawal. These are your journal entries. Okay, everything that you have here. I didn't need to go into journal 2. So this is your homework, guys. This is your demonstration. Review it, go over it again and again. Okay, so that you can understand what's happening in a merchandise company. I'll see you on the flip side.